But I think they go quite well hand in hand.
Absolutely,
Right? That's
Do they cancel each other out? That's my question.
No, they don't cancel each other out. They compound each other.
It's glorifying losing money.
Yeah, that's
'Cause,
right.
like, I may have lost 20
That's right.
grand, but I get 6 grand back at tax time, and I feel like I've made 6 grand.
Yeah.
You ready?
What about today?
He's ready.
Will removing negative gearing solve the housing crisis, or help solve the housing crisis? How long have you got?
How long have you
What
What time is it?
This is Property Now. I'm Michael Carboni. You can call me Carbs. We're back with Jason, the He-Man, sexiest
Good
voice
to
in
be
property.
back.
You never let me finish that. Sexiest voice.
Good to
in
be
property.
back.
You never let me. Yeah. And Chris Ferris, CEO of Coposit. Good to have you back, man.
Always a pleasure. Am I like considered a guest now on this show, or am I?
A special guest.
You're very special.
I'm a guest, right?
Yeah.
Like I'm a guest. That's great.
But look, the views are definitely up when
Since
you're
I
on.
left.
No, when you're on.
Nah,
I noticed you got a fresh haircut, especially for today as
just
well.
for today, mate. Got
So-
the vest on. When it's bloody hot in here, I don't know why I've got this vest on.
You can take it off.
I've committed to it now, so I'm
Yeah.
here.
Yeah,
all right.
Is that sweat? You're not nervous? It's just
No,
hot,
it's just
hot sweats.
Mum spaghetti. Yeah.
We're talking about M&M restaurants. We're talking about negative gearing today.
Wow.
It's a hot topic.
Okay.
Will it? And there's talk of some politicians talking about
Yeah.
abolishing negative gearing.
Yeah.
Will it actually help solve some of the problems we're seeing in the housing crisis? I'm really keen to talk to both of you guys about this because I know you both might have some big views, maybe some different views. Hopefully we can have an argument and a fist fight.
Yeah, sounds good.
But firstly, let's define the terms. Negative gearing, what is it? Who wants to take that one?
All right. I'll take this one. So negative gearing essentially is that when you invest in something, whether that's property, whether you're investing shares, right, and the cost of that investment, right, outweighs the income that you're producing from that investment, you get to deduct that off your personal income.
You can do it with shares as well?
Yeah, you can do it with shares. So that's a really good question because whenever you hear about negative gearing, it's always targeted at property, right? As negative gearing is bad property, but a lot of people don't realize that you can do negative gearing with shares, right? So you can do negative gearing with any forms of investment, not only property.
So in number terms, you have $1 million loan on your house.
Yep.
You are renting that investment property out.
Yep.
You might be getting $1,000 a week return.
Yep.
Your repayments are $6,500 a month.
Yep.
The shortfall between what you're getting in rent and what your loan amount is.
Yep.
That amount you can.
It's not just loan. It's all the costs.
all the costs.
Yeah,
keep
so
unpacking.
so the cost of having that investment.
So
So,
if
if it's an investment property, there's
You're paying more.
costs. Yeah,
Agent fees.
Correct.
What else?
yeah. Council rates.
Yep.
Yeah, you're potentially paying land tax. Property management for insurance,
Yep.
landlord insurance, building insurance.
So
So
whatever
let's
it
say
costs.
all the costs for
Yeah.
a year are 50 grand.
Yep.
All the costs.
Yep. And you
But
earn
your
40
income,
grand.
so the rent on that property is only 30.
30.
There's a $20,000 difference.
So what happens
Correct.
with that $20,000 difference?
So if you're earning 100 grand per annum on your personal
Salary,
that's your taxable
wages.
income, your taxable income is 100 grand. You can then effectively what it does is reducing your taxable income by 20,000.
80 grand.
So you can utilize
Quite
what
pretty
the,
nice.
the controversy behind it is you can utilize the property loss against a different asset or income stream being your personal income.
Yeah.
That's sort of the issue. Can you explain it for shares, Jace?
Yeah. So for example, so people that have equity in their property, they can borrow against their property, and rather than just using that loan to buy another property, you can borrow $50,000 against your existing property's equity, and then invest in shares.
But just to clarify, because I don't want to mislead anyone here.
Yeah.
You can't, if you don't have a property, so there's no equity or anything, you can't just buy shares and then if you're having a loss, you can't use that as negative gearing.
Yeah. No. So it's not the loss of the actual asset. So it's not, for example, if you
It's
buy
not a capital loss.
Yeah, it's not the loss of the assets. So that's the same as saying if you bought a property for 100 grand and a couple of years later it's now worth 600 grand. That's not the negative gearing part. It's the cost of holding on to that investment. So if you didn't borrow money and you bought shares with your cash savings of 50 grand, then you don't have an expense relating to that 50 grand.
Yep.
Right. So things like interest can be used for negative gearing deductions. Right. So some people might even take out a margin loan, which is borrowing money against the shares, right, from the bank to buy the shares. Things like, for example, if you have an investment the accounting costs related to managing that investment. Maybe you set up a family trust to buy shares, and there's $2,500 a year of accounting fees you got to pay. There's brokerage fees you got to pay. So those things are expenses relating to having that particular investment.
Yep.
Then you can use it as a deduction against your personal income.
Oh, I just want to clarify,
Yeah.
because if you've got $100,000 in shares and then you sell them for $50,000, there's a loss there of 50.
Yeah.
You can't use that $50,000 loss
That's
against your
right.
income.
That's right.
That's on the capital side.
That's right. So I think a good way
Just wanna make sure
to look at it.
clarify.
Yeah, so that's a really good point. So a good way to look at it is the expenses that you get to deduct from negative gearing is always against the income. So it's not against the value of the growth or anything of that particular property or asset or even business or shares that you've invested in, right? It's always against the income because the income is all calculated every financial year,
Okay.
right? So
in a nutshell, negative gearing is being able to utilize property losses against personal income that you may have earned. So again, $50,000 income, $50,000 in expenses. You may only be making $30,000 in rental, so income on that asset. And that balance of $20,000 you can offset against your personal income, therefore reducing your taxable income and getting tax benefits.
yeah, so one way I often explain it to my clients, just to make it really simple to explain the idea. So using your example, you've lost $20,000, right, for having that particular investment, right? So let's say your tax rate is 30%. So I explain it in a way that you've lost $20,000 for having that investment this financial year, but the ATO has subsidized you for $6,000 of that loss. Right, so that's the way you look at it. So rather than actually losing $20,000 of your money, you've only lost $14,000 because thanks to negative gearing and being able to pay less tax on your salary and wages, the ATO has supported you or subsidized you for that $6,000 difference.
And I suppose what happens a lot of the time is people are, if they're earning salary and they're PAYG clients, their employer would still be remitting the PAYG, so their tax to the tax office. What it means is that at tax time, at the end of the financial year, that $6,000 that you're talking about, if there's a $20,000 deduction or reduction in their taxable income, that $6,000 is a benefit that they receive at tax.
Is a refund, right?
It becomes a refund.
Exactly.
And I suppose that's where there's a bit of controversy in the fact that the ATO is subsidising people having investment properties.
And losing money.
It's glorifying. It's glorifying losing money.
Yeah, that's
Because
right.
like I may have lost
That's
$20,000, but I get $6,000 back at tax time, and I feel like I've made $6,000.
Yeah. That's
Right, in
exactly
that
right.
scenario?
Because that's how some conversations go at parties and barbecues, right? It's like, oh, why have you invested in property? Oh, because it's got negative gearing. But that's not the goal of investing in the property, right? So it's as if I'm investing in property so I can lose $20,000 a year and get $6,000 back. That's my goal.
Well, what business plan is like, hey, we're going to lose money?
Yeah. So
I can tell you one.
Yeah, no. But
sorry, I shouldn't laugh. There was a lot of laughing last episode.
I think what the issue is, or what the intention of the strategy for negative gearing is, people are utilising negative gearing. It is a tax benefit, but what they're hoping for in return is capital growth.
Yep.
So they're hoping that, okay, I do this for 10 years, I've bought something for $600,000. At the end of the 10 years, that $600,000 property is worth $1 million.
Well, the strategy is to go from negatively geared to eventually positively geared.
Well, sometimes it's not.
Usually.
Yeah.
Right. So, but eventually these property investors, they want to be old, grey, and have these properties that are completely paid off, that are just earning them an income.
A lot of the
retire.
theory behind property, and Jace, you can attest to this, is that you accumulate a substantial amount of debt buying properties, and the debt is what leverages you to have a higher portfolio or a larger portfolio. And then in time, and look, based off what's happened in Australia in the last 50, 60 years, property has gone up, not on a straight line, but has gone up substantially. And there's a hope that in 10, 15 years' time, which is probably going to happen, that property is going up between 4 to 8% annually, depending on where you buy, that the capital and the debt that you've accumulated helps the capital growth perspective, and there's a huge amount of equity in 10, 15 years' time.
There's equity. Your rent keeps increasing. Eventually, it tips over.
That's right.
And negative gearing, or being able to do it this way, is pretty uniquely Australian. I don't know if too many other countries do it, if any. And is it a coincidence that Australian property prices continue to go the way they go, and in other countries we see this whole boom and bust?
Yeah, but property prices in other countries as well have gone through the roof. Yeah. You talk about UK, you talk about Canada, talk about America. A lot of these locations where property's gone through the roof. It's not just from negative gearing or these implications. It has to do a lot with money supply and money coming into the market. But I know we've got a lot of worldwide listeners too. I'd be keen to see anyone in the comments that may live in those locations, what's happened to property prices, and are there policies like negative gearing in those locations that they think are also affecting property prices?
So if we all of a sudden took negative gearing away, say new government comes in and one of their big policies is we're removing negative gearing, what sort of effect would that have on the market, do you guys think? And it's obviously speculation, but what are your opinions on this?
Yeah, look, that's an interesting one, because I'm just thinking, because we made the point that negative gearing is not only available to property investment. So negative gearing is available to shares. Negative gearing is available if you were investing money into a business, right?
Let's keep it to property because it's most prevalent in property,
yeah,
right?
I just want to really just on that. It's not available. Like technically, it's not available to shares. Like it's only available to shares if you're borrowing against your house.
Yeah.
Yeah. So you still need the house.
You still need the
first
house.
place. Yeah.
Because I think it could be a bit misleading.
Yeah. Look, that's a good point, because like a lot of people do invest in shares using their savings and so
although
forth.
even if you're using it for shares, the negative gearing component relates to the property.
No, if you're investing into the shares, the negative gearing component would be related to what you're investing in, because your property could be owner-occupied property.
Yeah, but I'm saying it's because you've got a higher interest cost, right? Because you're borrowing more to buy those shares.
Yeah, so the
you have
interest,
a higher interest cost on the property, which therefore means you're technically claiming the loss of higher interest against the rent on the property, not necessarily the shares. I'm concerned with that.
So how about if you do it on your owner-occupied property? Can you still claim the interest if your owner-occupied property is an owner-occupied home loan? So you can still do that, right? Because it's related to what you're investing in. So just because your property or whatever you're using to borrow money isn't an actual investment doesn't mean that it's not tax deductible. So I could borrow against my equity, invest in someone's business, and that makes that component or that loan tax deductible, even though it's attached to my own occupied property, right? So it's the asset. Likewise, if I borrow against my investment property and I go buy a Ferrari, that doesn't mean that the Ferrari or that loan is tax deductible just because I use my investment property to do it, right? But you do make a good point, is that there are lots of people who are investing in shares who don't have property and can't borrow. And I guess that's why negative gearing is so prevalent in the property space, because you can do that from day one, right? Usually you're much more sophisticated as an investor if you're doing the share
I think
side.
like Carb said, a lot of the strategy starts off with negative gearing, and then naturally, whether they want to, unless they're continuously gearing up the property, it naturally becomes positively geared, right? With increases in rent over time.
We see it on Composite Street all the time. We interview, say that a certain generation, and they'll say, oh yeah, like I just bought my property and now like here I am. Like it's 40, 50 years later.
Yeah.
It does the heavy lifting, right? The property does the heavy lifting over time. So let's go back to the question while PJ
what impact will have,
What's the impact going to be? Because it's really interesting, some data, right? The Grantham Grattan Institute, right, estimates that property prices in Australia would fall if negative gearing was limited to new properties and capital gains tax deductions were halved. But they're saying it would fall by 2%, which isn't incredibly dramatic, right? It's not a huge fall, and it may be a short-term fall, I would suggest as well. But what effect, based on your experience or your thoughts, guys, what do you think? Chris, I'm going to throw it at you.
I think, look, it's a really hard one because, there's charts going back from 1999 showing when this came in effectively, but then there was also an increase of money supply at that same time, so from the Howard governments, where property has really taken off since then. But I think the case can be made on a global level or some particular locations where that's happened. In terms of removing negative gearing, is it going to be this silver bullet? I mean, I talk about property all the time about, it's not just one factor that is going to either bring property prices down or up. There's a series of multiple factors, but taxes absolutely have a huge impact in property prices. I think we're seeing that on a lifetime basis in Victoria, where there's a lot of investors you see stories all the time of investors leaving those markets because of particularly the land tax that's been introduced. You probably have better experience on what that tax is, but it's a pretty restrictive tax, and it's designed probably to get investors to sell up and free up that stock for first home buyers.
Yep.
But I believe the house price growth in Victoria over the last 4 years has been 8% over the whole 4 years, which is very low from historical
compared
standards.
to other capital cities.
Yeah, other capital cities and historical standards, right? So maybe the tax, because there's new taxes, that has had an implication. So therefore, one could argue by removing that tax, it could have implications for investors that they may decide to sell up property. Now, I don't have the exact numbers, but what are the numbers out there of people that own more than 2 investment properties? I.e., what is that group of people who own 2 or more investment properties? If we assume that we remove negative gearing and all that group decide to sell, what is the number of those properties?
I'll tell you, 71% of investors own 1 investment property.
So as in that I own my personal residence and one
Yeah,
other property.
one other property. Or you may not own your personal residence. You may invest and own 1 investment
So what's
property.
that number? Do we know what that number could be? Is it
We actually covered it off in one of our previous episodes.
Okay.
You know, when we talked about in terms of how many people actually own 1, how many people actually own 2,
We
how many
did.
people actually own 3.
It gets very
Yeah.
small, right? So
Yeah.
I've read recently as well that if people that own 5 or more is 1%,
That's
which
right.
is like about 40,000 people in Australia.
you made it? You're in the 1%, Jason.
All right,
Oh.
Jason, well done. So you're really taking advantage of negative gearing.
Oh.
No,
I'm getting
but
cancelled now. Thanks, Bubs. Guys, you
There
won't
goes that
see me
political
next
career,
week.
Jason.
No, but-
you and Albo are the same.
but it's a good point, right? Are investors going to run out of the market and sell their investment properties if they can't negative gear?
Well, that's what I mean. Like, let's assume that everyone that owns 1 investment property or more does decide to sell. What is the number of that? Like, what's the number? And is it going to have a material impact?
Yeah, I think we talk about this quite often on this podcast, is that there's no one silver bullet, like Chris was saying, that's going to fix or improve the housing situation. Negative gearing, supply, construction cost, council approvals.
Accumulation, right?
Yeah, so like I think often the media likes to talk about it because it's a story that people like to read about. It grabs people's attention as if negative gearing is the one thing that you change and instantly
everything's gonna
overnight
solve-
it
it'd be
will
solved,
solve the housing crisis. Right, but it's not. So going back to your question, I think it'll certainly make an impact in terms of, I think, people's sentiment towards buying an investment property. Now that the negative gearing benefit isn't there anymore, they'll look at their cash flow because you don't get the $6,000 subsidy from the ATO anymore. So you are actually going to lose $20,000, say for the year, and you divide that by weekly or monthly. The cost of holding that property will go up. So that potentially will influence people to look at other options. Doing something else, investing in another type of asset. But I don't think personally that just because you got rid of it, the market's just going to tank.
Well, if you believe prices are going to grow, if you are happy to get a certain rental yield, if all those things stack up for you as an investor, then the negative gearing shouldn't make that much of a difference.
That's right.
really.
That's right. Because people like investing property. Why? Because bricks and mortar, something they can see.
It's
right?
a safe asset.
Correct, right? It's stable. It's continually going up. Yes, it's not tracked like the share market every day. It's going up and down, right? But if you look at the trend of it, like what Chris was talking about, over the long term, it's continuously going up and appreciating value, right?
I think when you look as well, like if you're earning an income and you've got a bit of cash aside, what do you actually invest in? You've got property, you've got shares, you've got
super
a term deposit, super, or your own business, right? Like what else really is there
Gold.
that you can invest in? Gold,
Crypto.
crypto. But I mean, when I say shares, I mean like
Yeah.
digital, right? So, I mean, there's not a whole heap of other things that you can invest in where you can utilize debt, particularly like property, to really leverage a position. Like,
Yeah.
if you're buying $1 million property, you only need to put in 10%. And so you've got $900,000 of debt that you're really leveraging. So if that property goes to 1.1, you're not actually making a 10% return. You're making a 100% return on your investment. $100,000 turns to $200,000. But I think one other policy, and not to muddy the waters with negative gearing, but one other tax policy that's just as significant is the 50% CGT discount. That's probably, in my opinion, from an investor's perspective, getting a discount. So in Australia, if you hold a property for more than 12 months, you can get a CGT discount, which stands for capital gains tax discount. So what that means is, in numbers terms, if you buy a property for $1 million and it's worth 1.5, if after 6 months you decide to sell and it's owned in your personal name, you'll pay tax on the whole $500,000 gain. Whereas if you hold it for more than 12 months, you get a 50% discount. So again, $1 million purchase price, and I'm not talking about other costs, stamp duty, right? $1 million purchase price, $1.5 million sale price. That $500,000 gain is discounted by half, so $250,000,
You pay tax,
and then
on
you
the
pay tax
250.
on the $250,000.
And that's on an
That
investment
to
property,
me
right?
is bigger than the negative gearing component, because negative gearing is an annual amount. It's typically going to be like, it will cap out at some point before you actually just don't have enough income to support the negative gearing component, right? Like if you're earning $100,000 and making $100,000 loss on a property, you actually can't sustain it for very long if at all.
But I think they go quite well hand in hand.
Absolutely,
Right? That's
Do they cancel
the
each
key
other out?
formula.
That's my question.
No, they don't cancel each other out. They compound each other.
Yeah, but so if you're say you save $6,000 a year,
Yeah.
say on negative gear, but when you're negatively geared, if you eventually sell your property and then you pay all this tax at the end, does it just sort of balance out?
So you get the negative gearing on an annual basis.
Yeah,
And then when you come to sell it, you also get this 50% discount.
but you're still paying tax.
But you pay tax regardless.
Yeah, but you're paying 50% less tax.
Yeah. If you hold it for more
Okay,
than 12
sorry,
months.
I'm on. I'm with you.
So you're getting money back every year.
Yeah.
And
then
eventually you pay
save
less
half
tax.
the tax.
Correct.
How good is that, right?
Yeah.
So then,
Your cost base stays the same of your property price. And we're not talking about depreciation or anything, but your cost base generally stays the same. And then if it goes to 2 mil, 5 mil, whatever, that amount, that gain is halved effectively if you hold it for more than 12 months, and then it's taxed at half the rate. So there's also this incentive to not only buy an investment property, but there's an incentive to hold it long term and wait for this capital gain.
Exactly right. Exactly, because that's why people buy these investment properties chasing capital growth strategy, where they'll buy a house for $1.5 million, and they can only rent that out for $800 a week, right? But the loan is massive on that, so they're losing money every single year, accumulating. Even after you include and take away the ATO subsidy of negative gearing, you're still losing money, 14 grand, 20 grand, whatever that is. But ultimately, their goal is, I know that this $1.5 million property or $2 million house in a blue chip suburb in 10, 15 years' time will be worth 5-6 times this price, right? And when I sell it, I only have to pay 50% of the tax on the gain that I've made. You know, so that's a strategy.
I think the wider issue with how the tax system's set up for property, it encourages people to buy an investment property and hold it long term. So again, if you're talking that a property goes from, you bought it for $1 million and it goes to 2 million, you're less incentivized to sell that property because you're going to have a substantial tax bill. What you're more incentivized to do is gear it up, if you can, to have a higher mortgage and then unlock that equity to buy another property. The system is geared for you.
That's a killer formula.
Right, the formula, and to be honest, there's property spruikers out there
Yeah.
that's their strategy, right? In 10 years' time, every 2 years you buy a property, you unlock the equity. So if property's going up 5% a year, call it, if after 10 years, something's worth 1.5 and you've made a $500,000 gain, instead of selling it, because you're going to have to pay, what is it? You gear it up another 250 grand. So your loan becomes from 1 million to 1.25, and you can unlock that equity and then utilize that to buy another investment property. Your interest expense goes up on the first loan that you can claim. So the negative gearing compounds, and then you start the whole process again.
And the beauty of that, when you unlock the equity, that's actually cash into your bank account to then spend. That's tax free.
So you can.
Right.
So my point, what I'm trying to say is, you can sell the property, pay tax, free up a property for someone, or you gear it up with another mortgage. So you don't sell the property, you retain it, and you're not paying the tax. So it's tax free money.
So is there then a solution in the middle somewhere, right? So rather than abolishing negative gearing altogether, is it a matter of looking at, hey, do we have negative gearing for your first investment property, but then those benefits start to diminish the more properties you buy in your portfolio? Or is there a way at grandfathering it?
Yeah.
Or is there a way at, looking at specific types of properties? Like,
Yeah.
are there other ways that, or is that just
Are you saying to free up property that investors sell, or what do you?
Well, to fix the housing crisis.
to fix the housing crisis is what we're always
Like
sort of
I
talking
quite
about,
like the idea of using negative gearing with something else and not just on its own standalone. So, for example, negative gearing being available for brand new properties, right, to stimulate the supply, but you also grandfather, so meaning that you allow people who have already made a purchase decision because of negative gearing to keep what they have, but from a certain date, starting from today, right, everyone who's got an investment property having negative gearing, you stay the same. But for anyone buying a property from today onwards, if you buy an established property, there's no negative gearing. And if you're buying a brand new property, there is negative gearing. Because I think the people who are going to invest in established property with or without negative gearing, they're still going to invest in property if that's their chosen asset, right? But it'll encourage or incentivize people to look at brand new properties, which I believe will then help with supply issue.
help unlock supply.
Right, so it's not just the negative gearing problem that you're solving.
So you're saying to remove negative gearing on it?
So remove negative gearing for established properties from a certain point onwards, right? Let everybody who's already got it For established property, keep it, right? So you grandfather that. So you don't go change the rules on people who made a decision 10 years ago, all right? But from that date onwards, you only allow negative gearing on brand new property. So that can stimulate supply. So if someone wants to take advantage of the negative gearing benefit, they will look at buying a brand new property versus buying an established property.
That actually makes a lot of sense.
Like a hand-in-hand thing, not just get rid of negative gearing or keep negative gearing, making it sound like negative gearing is the only problem that's affecting the housing supply issue.
There's multiple tax policies.
Yeah.
It's very hard to take it away when so many people are invested in property. I mean, they tried to take it away in the 80s, and it did not go down very well, and they brought it back very quickly.
Because you only have to look at how many people own property versus how many people are aspiring first home buyers, right? So who is the government from a voting perspective going to look after when it comes to these policies? They're usually going to look after the majority, right? And unfortunately, the majority are homeowners.
But if it helps people get in, I'm saying, like, if you get to the point where you own multiple properties,
Yeah.
then maybe you can't take the advantages that someone getting their first investment property. Like, maybe we want to help the people get their first property more than we want to help people get their 20th property, for example, right?
Yeah.
So maybe there's a scale where it sort of the opportunity to negative gear declines over a period of time, right? And you're not, again, from a political standpoint, the 1% of people that own 5 properties or more, you lose their votes.
Yeah.
Maybe it's kind of like a so what.
That's a good point, because that's like in Shanghai, where the property market's super expensive as well, like Hong Kong and so forth. And the government put in a policy that you can't own more than 2 properties. So you can have your personal residence, you can go buy an investment property, that's it. Right, so it doesn't matter how rich you are or this and that. Personally, you can't keep accumulating 7, 8, 9, 10.
I kind of hate that too.
Right.
We should never say no. That is your limit. Like, we should never say that as But maybe it's like, maybe you don't get as much of a leg up because you don't need the help. Clearly, you don't need the help anymore. But for someone that's first home buyer or first time investment property buyer, like, let's help them. But again, it goes back to what you always say, Chris. Like, the more government stimulation that is out there, that's actually the artificial like stimulation of the market is what has caused all the problems, I would suggest, in the past.
Yeah.
So do you just stop it?
Well, look, I mean, the policies are there, and they're there for a reason, right? And people play within the boundaries that are set by them, so by the government itself. So if the policies are there to negative gear and capital gains discount, then that's what the policies utilise. It'll encourage more. I mean, an interesting point, if you increase the capital gains discount to 100%, so let's just say it was 100%, would that encourage people to continue to hold or to sell some of their investment properties?
Might continue. It might get people selling earlier, potentially.
Yeah, because if you owned a property and you purchased for $1 million and it went to 1.5 and you had the opportunity to pay no tax on that, maybe that frees up properties.
But why just property then? Like, if you sell a business for a massive profit, then you're going to pay.
There's some early concessions that you can get on selling shares in a business. It's called the ESIC program, early stage investment, that allows you to tax free. There are provisions out there.
Or when you're like, I think a certain age, like you're 55 or something like that, and when you sell it, there's some exemption gains. But I think it's a good point, right? So then you can apply it to shares, right? So why is it that if I buy shares in a bank and then it's gone up by 100 times, the property guy has 100% discount, right? Doesn't have to pay any capital gains, then I should, right? Because then that's where the argument would be, right?
If I buy bank shares for $100 a share and then I sell them for $90 a share, why can't I?
Yeah. Well, it's always like that, right? It's like, why is it just this particular asset class? But I think going back to Chris's point, it's people playing within the rules. Like that's how the rules have been designed. It's not exclusive to property, but it's more commonly utilized for people buying property, right? And people are all playing within the rules. Like the rules are available to all asset classes. It's not just property.
All right, bit of quick fire before we wrap this up. Because a very interesting discussion. But okay, say we abolish negative gearing. Will investors start to pull out of the market?
Yes, no. Oh, look, I think so, yeah. Yeah, well, because there's some investors that are heavily reliant on negative gearing to maintain their cash flow because the cost of having that property is going to be too high, right?
I'll say yes, but I don't think it's going to materially affect property prices.
Not in the long term, I don't think either. Will it affect rental prices? If investors are pulling out, are rents going up? And also, if you're not getting that tax back at the end of the year, do you up your rent to try and recoup some of those costs?
Oh, look, I think so. Like, I think some owners in the market will do that, just like when the interest rates increased. Right?
Potentially. I mean, the argument to say is, well, that renter could then become a homeowner and buy that particular property.
Yeah.
For example, that's the argument. So, well, if that landlord's selling, that renter could potentially buy that property, so it frees up the stock. So, does it affect rental prices? It's based off demand. Rent increases is based off the demand of a particular property. If that landlord selling that property means a renter buys that property and they're now out of the market, maybe it doesn't impact as
Well, I
much.
guess someone's got to buy it, right? Either an owner or another investor.
Yep. But that just shows it's not the only thing, right?
That's
It's
a
not.
series.
It's not the only issue that's going to fix. It's oversimplify it really. But that's what the sort of public discourse tend to do.
I think it's a good example of a political issue that gets highlighted by politicians, maybe in opposition, where they're trying to win votes, maybe of the youth that feel very disconcerted with the negative gearing impacts at the moment, and that the fact that they can't buy houses. So anyone, under 36, which is the current age of a first home buyer, anyone under that age, which is a huge population, majority of Australians, and they're voting age Australians, working Australians, or studying Australians, for example, that politicians may be trying to win their votes, for example. They try and take on these policies which appear popular to that cohort of buyers to try and take on that particular issue.
Yeah.
So if you were a politician, which one day
No, I'm not.
you might be, I keep trying to push Chris into politics. I
thanks,
feel
man.
like you could make some good changes. Would you consider something like that?
I think if you're in politics, the best way to look at it is look at every potential option. I don't think you should rule anything off the table and look at what those impacts could be.
Answer like a politician. You didn't answer the
Well,
question.
I think you've got to look at everything, right? You've got to look at everything that could affect the market. My personal belief is there's multiple things that affect the property market. I think negative gearing and capital gains tax are slices of the pie.
And because of that view, that's why he won't be in politics. Because in politics, it's all about the popularity vote and targeting a certain segment and looking at that one issue, right? So if he's someone in politics looking at all these things, right, together, he's then he's not going to particularly identify to a particular group of people, right? And that's what they're always targeting. They're always looking for that popularity vote because that's how you maintain your survival in politics, and that's the problem, I think.
Nice. Guys, negative gearing is probably here to stay, I'd say. But nice to chat about and really try to unpack and learn what it actually means, because if we are going to vote on policy at the next election, which it sounds like it's going to be a big topic, we really want to understand what it actually is, how it affects us, and what taking it away might mean for Australia. So great to chat to you boys as always.
Great topic.
Pleasure,
Thanks, Cubs.
The Property Now podcast offers opinions on Australian property news for informational and entertainment purposes only, and they are general in nature. It does not take into account your objectives, financial situation, or needs. It does not constitute professional advice. Always seek expert guidance before making any property-related decisions.